We are live. This is Value After Hours, joined as always by my co-host Jake Taylor. I'm Tobias Carlisle. Our special guest today is Josh Young of Bison Interests. He's the founder and managing partner. It's an oil and gas public equity investor. How are you, Josh?
I'm good. How are you?
Welcome.
Tell us a little bit about Bison Interests.
Sure. So we launched in 2015. The thought was that after the oil price crash in 2014, capital had fled the public markets and was being directed into the private markets in oil and gas. And I guess also sort of a broad private equity boom was going on there. And so we thought we'd go buy some small caps at a low valuation, and that buying value with catalysts would yield outperformance over time. And so we were right about the outperformance relative to small caps and relative to oil and gas stocks, and we were wrong that oil and gas stocks would go up over the following decade. And so our benchmark is PSCE, which is like the small cap ETF, and I think it's down something like 75% from when we started. So and we're up somewhat. And again, none of this is an offer or solicitation, recommendation, anything like that. But that's what we do. We try to just find value priced oil and gas stocks. And then actually one time I joined the board of a company and became chairman and replaced the board and replaced the management team and sold it and did real well versus the other companies in that area. And that was a Canadian small cap.
So this
So
is like the when your benchmark's down 70%. This is like the what's that meme where the guy's
lots
like
of alpha.
fighting the third place he's celebrating on the podium, but he's in third.
Yeah, good performance relatively, and
Yeah.
you're still like, massively lagging. And the reason to talk now and the reason that things are interesting is that historically cyclicals underperform for parts of the cycle and then they massively outperform. And there's sort of the broad cyclicals and then there's sort of specific sort of niches, and oil is probably one of the biggest of those niches. And what historically happens is in almost every cycle, you have such extreme outperformance in the up part of the cycle that you lure in enough capital to be able to get over investment and crash the market and so on in that niche. And so you need to have that period of massive outperformance over a multi-year period. You need enough capital to get a capital cycle to lead to that destruction. And so we haven't really had that. We had a couple of years that were okay, 21, 22, but we're what 15, 16 years into this down cycle that started in 2014. And so or sorry, 11 years into that. And so at some point you're going to need a material upcycle, and small caps, when they've done this poorly historically, they've done really well in cyclical upcycles. And that's the theory. And then with almost no one actually picking any of these stocks, and with it dead and seeing disgust and concern and various other things when you tell people this is what you do, that's it's very exciting as an active manager in the space.
Well,
Yeah,
fair
I think
play to you for surviving and sticking around and staying the course. That's you get a gold star in my book for that.
Actually, I got better than a gold star. Here, I'll show you. I got to go to Vienna recently, and they gave me a little oil drum with a little. I don't know which country it's from, but from OPEC. They had me come out and meet with them, and yeah, so that was pretty recent. Then, of course, they dumped oil on the market like right after.
Just
But
killed you.
yeah, but at least I got a little plastic oil drum.
Yeah, I think small and micro, more generally, like not just oil and gas, although there's a big oil and gas component to this to the cyclicals that I look at. It's looking more value and better value than I've seen in a long time. I think they're looking very, very interesting and healthy at this point. But let's talk specifically about oil and gas. Just give us for folks who are tourists in the oil and gas sector, maybe give us a little
Like
guide
history of
to
the last 15 years or something.
yeah, where we're going, where we
Sure.
are, where we're going.
Sure. So what historically has happened is um, you'd have a down cycle which would last for a while, typically around the discovery of one or more large fields. Um, and you'd have development of those fields. Typically, development costs were quite low. And the way back when you'd have, 1,000 rigs all on just one little area, all right next to each other. And then sort of as things progressed and there were sort of better rules on these things, you'd have fewer rigs and sort of more efficient development of fields. And that's the down cycle is you have a discovery and you flood the market. And then as those fields run out, you have a big upcycle that induces enough exploration and delineation to be able to crash the market again. And so we had this big discovery, which was a little different from what we experienced historically in the US with innovation from an engineering perspective for shale. And that really kicked off in 2010 or so, the sort of innovations. And it took a few years for it to get big enough to crash the market in, let's say, 2014, 2015. And so we've been in this really prolonged down cycle for oil and for natural gas because of this engineering innovation and because of the roughly 10 million barrels a day of production growth from the US, from Canada, from a couple other unconventional basins, and then also a little bit of innovation around deep water development, which has sort of provided the rest of that marginal, let's say, 10 million barrels a day of production. And so we're at the tail end of that. And there hasn't really been much exploration or innovation outside of shale and outside of, to a much lesser extent, deep water drilling. And so I think it's getting really interesting. We're seeing it already on the gas side, where gas prices are higher, but the rig count isn't up much and production has sort of flattened out. And then on the oil side, too, there hasn't really been much oil production growth for the last couple of years in the US. And either we're at sort of a geologic limit or we just need higher prices to get that next set of development. So very high level, that's sort of where we're at and where we sit. And just from a narrative perspective, every cycle at the bottom, people say, oh, it's done and it's over and you can't invest in that and it's trash and it's terrible. They come up with all kinds of, there's moralistic stuff, there's economic stuff, there's, Buffett would say this about airlines, but I'm sure like they would say it about oil companies too, like, oh, capitalism would have been better if they shot the Wright brothers out of the sky.
Yeah.
Anyway, that's where we're at. I think we're very close to, if we're not at a bottom for the cycle, because of the similarities to other bottoms, as well as what we've seen with the production trajectory. And then there's weird narratives on demand every cycle. And the reality is that demand for oil has grown by about 1% a year globally for 40 years, other than COVID. And independent of narratives on electric vehicles, various other things. And then for natural gas, demand is booming and supply is not. And so, sort of parallel markets, some wells produce both oil and gas, some just produce one or the other. And so that's I think where we're at in the cycle.
It's an interesting kind of counterfactual to imagine a history where we didn't get shale at all, or it was stayed like, too hard or technologically. And I don't know, imagine $150 oil for the 2010s period. What would that have meant for inflation? What would that have meant for what the federal funds rate looks like? How much can you juice the economy? Like what, how much can you borrow as the US government? Like there's all these knock-on effects of imagining $150 oil for a decade. Um, Quite interesting, actually. Like maybe one of the bigger sort of untalked about historical influences.
Yeah, I think if you think about the US sort of economic miracle over the last couple of decades, almost all of it is explained by low prices for electricity and chemicals for natural gas, as well as substantial incremental revenue and capital expenditures for oil and for gas. So it's not just the higher oil, where maybe you'd have $250 oil, because if you look at sort of how ridiculous it's been that you have oil prices at 20-year lows, but eggs or cars or other sort of physical things that are sort of similar and cyclical in a lot of respects are, 5 times more expensive than they were, let's say, in 2007. So in addition to that, which would have really changed the world quite a bit, you would have had 10 or 15 or something dollar natural gas without gas shale. And that would be a very, very different world with very
And it's like
different winners.
four today, right? And roughly
Yeah. Yeah,
two.
like 450, but it
Yeah.
was two for, a while, and I think an average of like three for the last 10 years or something like that. And so we've really benefited a lot, and we've spent hundreds of billions of dollars invested in the US, which people think, oh, it goes into the ground, but the reality is most of that money is labor and then parts and equipment that's built and replaced and repaired. And so the recycle, I mean, this is where I'll just touch on it just very briefly. Like if drill baby drill would work, it would be amazing for the US, but suppressing the price and encouraging OPEC and others to produce is massively negative for the US economy. It's a very, very big positive effect, very rapid recycle of cash that's invested in drilling for oil or gas wells, especially on the shale side. And it's been, I think, actually quite depressing for the US economy in the last couple of years as the rig count has fallen and as production has sort of flattened out both for oil and for natural gas.
Before we came on, I had pulled up the oil price, and it looked to me like it topped out in. I said before we came on, I said to Josh, it was May 2022, and he said no, it was June 7, 2022, and I think it was like 124.50 was the number I saw. But what was the number, Josh? Do you know?
I think that was probably WTI. I think Brent was like 130 or 132, something like that. I should know the exact number. I know the day better than I know the exact Brent
And it
peak.
was negative like the a year before that. Is that accurate?
Yeah, like 24 months before it.
Yeah, okay, so 2 years before. It's wild.
So we're at where are we now? We're about $70, $66, something like that.
Yeah, 66.
Is that like fit the is there a lot of production that is reasonably at least like earning a cost of capital at $66?
No. So there's sort of two
Okay.
questions. There's like
I'm
what
glad I
breaks
asked.
even? Yeah, what breaks even on OpEx, which most production on right now is profitable on from a pure just lifting cost and operating cost perspective. The companies are making money on existing production. But the funny thing about it and the thing that makes it so powerful from a potential cyclical perspective is that most of this production that's grown in the past decade is ultra high decline rate. The first year
Mm,
wells, they
yeah.
decline 70% plus. Even in your fifth year, sixth year, you're still talking about 20 to 25% annual declines on the production. So the overall base for US production is declining something like 40% a year. So it's not just the OpEx, it's you want sort of the full cycle, you want the CapEx. Frankly, these days you also want to count the inventory cost because a lot of the companies are having to reinvest a lot to replace their development inventory. And so that break even is probably closer to $90 WTI. And the evidence of that is that the rig count has fallen. If you look back to 2022, it grew for a few months after oil peaked and then it started to fall. The oil and gas rig count, I believe, is down somewhere in the 30 to 40% range since then. So that's displaying we're in supply destruction territory from a pricing perspective.
Mm.
So when you see that, where do you? I mean, if we need to get back to $90 just to see break even, like what's the prospects for that in the short to medium term?
So one of the biggest overhangs on the market has been OPEC with their spare capacity. And so we think OPEC has about 3 million barrels a day of spare capacity, and the market thinks that it has about 6 million barrels a day of spare capacity. And um, unofficially, let's just say that that's not really an OPEC number, that's an OPEC member number. And the OPEC guys might agree with us more than they agree with their member countries, but that's not official. And they don't sort of have a specific, they don't provide numbers that they say they can't verify. And so as that production comes on, that's sort of been what the market's been reacting negatively to. As it comes back on and that spare capacity number falls, you could end up seeing prices rise a lot to the extent that inventories don't rise. And the EIA just came out, and the EIA has been pretty pessimistic on oil and bearish and so on for the last number of years. And they showed over a million barrel a day supply deficit for February. And so if that's true, and again, we'll see, like these short-term numbers are very difficult to get right. People have strong views on them, and they're almost always wrong. Whether they're vendors or government, officials or like traders, they all have very strong views. And it's sort of helpful to say, okay, hey, like I'm not exactly sure, but like, y'all have like a 90% error rate. So I'll just like discount all this heavily and say, hey, this is sort of what it looks like. It looks like we're in a deficit even with the recent additions from OPEC. And I think as that spare capacity clears without flooding the market, we're set up for potentially. I don't think we go like evenly from 66 or whatever to 90. I think we clear at some price. I'm not sure exactly where, and then go way higher when we don't see the supply response that everyone's expecting. And the scary part about balancing the market is OPEC was there to balance the market. As their oil comes on and as there's less spare capacity, there's room. There's not really a lot of precedent for oil or for other cyclicals to sort of hit like a medium, like Goldilocks type price. They typically go from supply destruction pricing to demand destruction
Glut. Yeah.
pricing, and they swing. So we're in a sort of glut right now. It's a weird glut because the inventories are declining, but we're going to go from this glut to consensus deficit, and that would be a sort of 150, 200, whatever dollar price type environment, at least on an inflation adjusted basis.
One thing that's always kind of impressed me or I found odd is the on the total production and consumption, like the price moves on to me what seemed like very small differences as a percentage basis of that total. Like it seems like it's all run really tightly as far as kind of like a stock and flow system looks. And like I don't know if you could help us visualize that or if you've thought about that in ways that might, explain that better than I just did.
Sure. So the best model I've come up with for that is actually from Morgan Stanley, and they published this statistical. I think Toby, you'll like this quite a bit. They have a dispersion of prices over time, and it's like a frequency chart. And basically, oil prices hang out either in supply destruction territory or demand destruction territory, and they're
But never
almost never in the
equilibrium.
middle. Almost never. Yeah. And so we were in this very weird position for the last couple of years where we were sort of like hanging out in equilibrium-ish. It was leaning towards supply destruction because the rig count was falling, but it wasn't catastrophic. And so, you see this sort of, it's a bimodal price condition, essentially. You're either supply destruction or demand destruction, or almost never in that Goldilocks type situation. And so what you're observing is the market being in a big degree of uncertainty and being in a sort of unstable price situation. And so that sort of middle ground that we found ourselves in for the last couple of years, it was very unstable. And that's where I think there was so much debate and so much contentiousness because the question was, hey, is this 2014 and we're about to see another 3 million barrels a day of shale or offshore or whatever, right? And you're going to see the price collapse. Or is it like 2003 and you're about to see prices rise a lot for the next 10 years? So that's, I think, the real debate. And that's why you're seeing that sort of tension. It honestly, there's like a negative correlation between a lot of these sort of short-term statistics and price movements. And that's the best explanation I can come up with is just that you're like zoomed in way too much and there's really this like much bigger sort of battle going on. And the reality is that honestly, I think the Bears have won in the sense that we are in supply destruction territory. And at 66 right now, inflation adjusted, you're talking about like 40 from 2007. And so we're there and or 50 from 2017, but you have policymakers and other folks that are looking at it thinking, oh, this price is high, not factoring in the crazy inflation and everything else, including labor and steel and other stuff that goes into it. And so anyway, I think that's what's going on. It's a great question. People don't really talk about it, but the problem is, hey, what happens, right? If you're into supply destruction territory already, right, and it's sort of volatile, but in there, is it more likely that you stay there or it gets worse, or is it more likely that over time that gets worked off and you end up, going much higher? Like where to next? And my view is where to next is much higher, but there could be some pain in between now and there.
How do you like oil and gas as a sort of economic indicator where if it gets to, it seems to in the past where it's where oil and gas has spiked, that's led to a slowdown in the economy. And then either as a kind of consequence of that or because the economy slows down, then oil and gas prices sort of tend to follow suit. If we're going into some sort of recession here, how do you feel over the shorter to medium term in relation to oil and gas prices?
Yeah, so the there was a famous commenter who I won't call out by name who would talk about how the oil market always cleared based on the current situation and not the forward expectation, and that's changed. And that commenter was a famous oil bull and actually now is bearish, which is very exciting to me. Like that's the I just want to see this capitulation come in. Like we named our
Yeah.
firm Bison. We're just
Last
gonna
man
face through
standing.
this. Yeah, we're gonna face through this. But man, like seeing multiple competitors that either represent themselves as bullish or whatever, or like, these various pundits that, were super bullish at 130 and now have like fully capitulated and whatever. Anyway, the theory is that these things clear on current expectations. The reality is that with a giant paper market and a much smaller physical market, I mean, the oil market's big, but the paper market for oil is enormous. There's a lot of room for forward expectations to get priced in. There's a very cogent argument that you already have a pretty bad US recession and a moderate global recession priced into oil at current prices versus current oil inventory levels and current supply demand deficits. So again, it's very wonky and some of this stuff is often wrong, whatever, but there is a pretty good argument that you're, let's say, $10 to $20 mispriced too low right now, and that positioning is so extremely negative. And there's like what you can see and there's what you can't see, and the positioning you can't see is even worse than what you can in the CFTC data and various other stuff. And so I think we're in a weird position because of that forward-looking spot price for oil, which again shouldn't happen but is. And to me, that's very exciting because again, you've gotten pushed into this supply destruction territory, but the fundamentals are actually you should be pricing demand destruction, not supply destruction, because you're undersupplied in the market. Then again, like your cushion from OPEC and so on is diminishing right now, potentially pretty rapidly. And so that's where, again, like to me, it's not just that I've owned this stuff for a while and want it to go up. It's fine, right? If it's going to go down first and then up, I'll survive. We own very, very cheap stocks that I think are mispriced even at lower commodity prices than today. And so we'll be fine. But I think the setup from the market and the level of capitulation as well as positioning is way too negative. And I think as it just normalizes, there's room for it to go crazy. And again, a lot of that is just where the price is versus where the current economic reality seems to be.
I could see that kind of like as a signal decaying over the time as the energy intensity of the economy comes down as well, right? Services are just require less energy than manufacturing. But yeah,
Is
that's
that
interesting.
the
Yeah,
case? Does the energy intensity of the economy come down?
it has, but it sort of makes you wonder about what's what's left. So some of
We're all
it's like
making
sort
burritos and financing everything. That's the
Podcasts.
Yeah,
podcast.
yeah, exactly. Like podcasts aren't very, we're doing this virtually. If I flew out to LA to do this, then it'd be a little more oil intensive, but we're not. So yeah, I think reindustrialization, which we're seeing now in Europe, at least they're talking the talk on that. And then, Trump and Canada, various other places, like reindustrialization, like breaking trade is bad, but reindustrialization is very, very energy intensive. And I think in the next downturn, we're going to see just how real some of this economic activity that we're measuring is. And, I try to avoid being super bearish, but, it is like the American sort of miracle has been wonderful. But some of these numbers are funny, and there are whole asset classes that have no cash flow and no fundamentals. And there's giant amounts of money that's supposedly been created or whatever, and economic growth associated with things that have no they're just, computer things. There's no there. So that aspect I think might go away. And it might be that the energy intensity of the economy has never fallen. It's just been that we were measuring some of the wrong things.
Yeah, I can buy that argument for sure.
How does the new administration's policy sort of impact the oil and gas market as we go forward? And I haven't followed it closely. It's not a political comment. I'm just sort of interested from a business perspective.
Yeah, it's um bipolar, let's
Well, it
say.
changes
And
changes every
Yeah.
45 minutes,
Yeah.
doesn't it?
That's why I
So
haven't been paying that much attention.
yeah, if this is recorded, whenever someone's listening to this
yeah,
at
it's
some
already
point in the future, it's
stale.
going to be different than what we're saying. But look,
Tomorrow.
like I think uncertainty suppresses economic activity, it suppresses investment. And so I think generally that comment is negative. That said, deregulation and lower taxes or lower whatever should, in theory, be beneficial. And then tariffs, if the goal is to actually lower global barriers to trade, that's really positive. If the goal is Smoot-Hawley style, 1930s suppression of trade, then that would be really, really bad. And so again, just I don't think we know. I think we know that the even just the energy policies are bipolar, inconsistent, and disappointing. And I will say, like, I had really high expectations of the folks that came in to run energy policy, and they've like massively underwhelmed. And so hopefully they deliver, but like massively underwhelmed. These are people very successful in the private sector, and frankly, like they could be making a lot more money and not embarrassing themselves if they went back to that. And it's just very odd to see people sort of agree to totally, like, I was the word, like beclown themselves or whatever. For what end, right? Like bipolar policy doesn't yield any positive results. So again, sort of I'll get off the soapbox, but it's very, very weird, and it is concerning short term from an economic perspective because uncertainty does suppress economic activity. That being said, I think the fundamentals for oil and gas are powerful enough that we may overwhelm some of this policy uncertainty and policy failures very shortly.
Josh, what would be the counter argument to the thesis that being long-term long oil and gas is being short human ingenuity?
Um, I think it sounds really good, right? Because
That's
in the
why I said
last
it. I mean,
decade,
it's
yeah, because in the last decade, we saw human ingenuity crash the oil price and crash the gas price and keep it low. We're seeing maybe the failure of human ingenuity as supply disappoints, and at least on the gas side, prices rise. Gas was the first mover on shale. It came way sooner than
yeah.
oil. Oil's way harder. So if you're seeing price rise, you're seeing supply disappoint, you're seeing core exhaustion in these fields on the gas side. I don't know why you'd think that you're not going to see it even more so on the oil side. So anyway, I don't know. There's like these weird sound bites, and it's great for like selling subscriptions or whatever. But like, there's a reality which is that on one hand, there's human ingenuity. On the other side, there's sort of Malthusian, scarcity, and we've balanced that very well as a species over our modern era. I'm not saying that we won't be able to solve very high oil prices, but the history is that you need those price spikes in order to incent the investment and time and ingenuity to be able to get to another period of low prices. And I think the fact that that's so popular and such a sort of common conception itself is sort of a good indicator that we're about to experience a period of much higher prices and concern around the ability to innovate out of them.
It does
I'm
feel like
glad.
we've kind of landed a few Hail Marys over time of like the Green Revolution with like the productive output of agriculture from all of our various methods that we use, like huge productivity increases there to the point like we could feed 8 billion people. Like that was a real question mark for a long time. And then, shale I kind of put in the same thing of like we landed a Hail Mary. But like sort of this expectation that you're always going to keep landing Hail Marys as a species, like that might actually be a little bit of a dangerous idea that uh we've all kind of generally accepted.
Yeah, I think it's not that we won't, it's that we won't consistently, and that these Hail Marys are the result of enormous amounts of money and time. And so when you deprive the money by going through a multi-year downturn, then you end up increasing the odds of experiencing a period of shortages. And we've seen this on agriculture, we've seen this in other commodities. I mean, that's what it means for a thing to be cyclical, right? Is that you don't end up we haven't solved agriculture. We've improved productivity, but we also have various challenges associated with it. I don't think we've solved oil and gas either. We just, we've improved productivity for a period, found some good resources, and then I think there's some risks around that, and those risks increase. Like our base thesis was, hey, there wasn't enough exploration or delineation going on even back in 2015, and this problem would just compound over time. And so we've seen it compound over time, and we see it as a way worse problem now than it was in 2015. And there's almost no one going and doing anything about it. And so as you only discover 10 or 20% or so of the reserves that you produce in a year, eventually you run out of those reserves, and then what do? And it's not that there's not that oil there or that ingenuity. You just are going to experience a period of too high prices and too much focus on the thing, just like we experienced a long period of arguably too low prices and too little focus. So it's not we can't do it. It's not that it's going to be horrible forever. It's just, hey, what is it like good times lead to weak men and weak men lead to bad times and bad times lead to strong men sort of
Hmm.
circularity. So it's similar for cyclical. So it's not impossible. We're not going to have peak oil or anything like that, but we will require another reinvestment cycle. We haven't had it. And I believe in human ingenuity, but also, we need high prices and focus in order to be able to get that.
Hey, Josh has to run. We're going to stay on and do Jake's veggies and go around the horn. So, Josh Young, Bison Interest, thanks very much.
Yeah, let's have you
Yeah,
back
thanks
on
for
soon,
having me
Josh,
on.
and get some more of your thoughts.
Yeah, absolutely. Thanks for having me on. You guys have a great podcast. Have a good one.
Thanks, Josh. All right, folks. Let me just give a shout out. Boise, Cleveland, Bethesda, Max in Valparaiso, Hawaii, Bendigo, up early. Milton Keynes, Toronto times two. San Rafael, California, Brandon, Mississippi, Tallahassee, Tomball, Texas. We appreciate it, Tyler. Bremerton, Helsinki, Camus. Nah, Goon. That's not a real place, Les Winan. Nokia, Finland, Jupiter 2. Lucky guys. San Diego, London. Zagreb, Croatia, Albion, Gothenburg, Sweden, Antwerp, Belgium, Madeira Island, Portugal, Kennesaw, Georgia, Cincinnati. This is a good spread. Amazing. Karachi, Pakistan.
Wow. All right, enough of this tomfoolery.
Hang on, I've got to get this last one out. Zevenbergschen, Hook,
He'll read anything, folks.
the Netherlands, almost Nashville. I skipped over. I skipped
Something.
over one that might get us cancelled.
Okay, that's too bad.
But you have to check into the. You have to check in, see which one I skipped over.
Uh,
Nashville. JT, hit us with the veggies.
yes, sir. Today we're going to be discussing philosophical razors, and so we'll start out by saying,
Occam's.
so that's going to be number one, but let's not bury the lead, Toby.
Sorry.
So have you ever found yourself stuck in a debate, tangled in a web of confusion, overwhelmed by the complexities of life? And is it me, or does it seem like there actually is a lot more bullshit in the world these days that you kind of have to sort through? Today, we're going to be sharpening our minds with some powerful intellectual tools, which we'll call philosophical razors. And these 10 principles, if you will, help us slice through the nonsense, avoid logic traps, and ideally, at the end of the day, make better decisions. So let's kick things off with Toby's favorite, Occam's razor, the most famous. And William of Ockham was a 14th century Franciscan friar, logician, and theologian. And he often found himself in trouble with the church because he had these radical ideas about simplicity in philosophy and theology. And sometimes, they say that like every profession is a conspiracy against the laity. When you try to make things too simple, that's why all the religious stuff was written in Latin. But so he was forced to flee Bavaria, and then he spent his later years writing. And so his principle, as everybody already knows, is
Can I before you can I have a go at it?
yes,
See if I can remember it. So I think it should be stated as prefer the explanation that assumes the least.
sure.
What do you but give me give me what
Well,
it is.
I'm not giving his exact writing here. I'm translating it, but it's the simplest answer is likely the correct one.
You didn't read it in the original Latin,
Yeah,
JT.
yeah, exactly. So let's just do a little example. Picture this. Your TV suddenly stops working. The reason it's unplugged, or maybe the power's out, or wait for it, the government has hacked into your living room to make sure that you're not watching the wrong news source, right? Now, which of these seems more likely? Probably the simplest explanation is usually the correct one, and Occam's razor reminds us not to overcomplicate things. So let's go to number two. This is Hanlon's razor, and that is never attribute to malice that which can adequately be explained by stupidity. And unlike most philosophers on our list, Hanlon wasn't a famous academic. He wasn't a scientist. He was an ordinary guy who submitted this phrase to a joke book in the 1980s, and apparently it stuck. And so it's actually gained worldwide recognition, and it's often compared to Napoleon had said at one point that incompetence is more common than conspiracy. So it like pretty much rhymes with that. But um, you know, let's go the and I think also one's a little bit reminded there of the fundamental attribution error from psychology, which is that we often judge others harshly based on their actions without taking into account the situation that they're in. And when it's us, when we're the ones who mess up, it was the circumstances. It's not that we're a bad person, right? So next time someone cuts you off in traffic, maybe they're just distracted and they're not like a supreme a-hole. Next up is Hitchens' razor. What can be asserted without evidence can be dismissed without evidence. Christopher Hitchens was a journalist, intellectual, fierce debater, actually pretty clever, funny guy to listen, argue with people if you like that kind of thing. And he spent most of his career challenging political propaganda, religious dogma, and arguing that extraordinary claims require strong evidence. And this is really, a kind of a skepticism's razor. So imagine that Toby tells us that he has a pet dragon in his garage, and we ask to see it. He says, "Oh, it's invisible." Well, according to Hitchens' razor, like we don't need to waste our time disproving that there's not a dragon in there because he hasn't really given us much evidence. We can just move on. So no evidence, no belief, big time saver. Closely related to that is Popper's falsifiability principle, which is basically for a theory to be truly scientific, it has to be falsifiable. So Popper was an Austrian-British philosopher of science, and he was frustrated at the time by the way that Marxist theories and Freudian psychology could twist any outcome to fit their claims. And so he sought a clear way to distinguish real science from what he called pseudoscience, and his solution was falsifiability. So basically, like if it can't be tested and potentially proven wrong, it's not science, it's pseudoscience. So, for instance, the claim that crystals heal diseases, let's say, how do we test that? We can't. So it isn't really much of a scientific claim. And I'll leave placebo effect out of that for now. But all right, next up is Sagan's standard. Extraordinary claims require extraordinary evidence. And this is kind of related to Hitchens' razor, but Carl Sagan was a renowned astrophysicist, science communicator, author, all around pretty awesome guy. And he spent his career promoting critical thinking and scientific skepticism. And, let's say that, if Toby tells us that he saw a UFO, should we believe him based on some blurry photo? Sagan would say no. If the claim is very extraordinary, then we need the evidence to be just as impressive. Next up, Brandolini's law. This is the bullshit asymmetry principle. Alberto Brandolini was an Italian programmer, and he coined this principle in 2013 after seeing how easily misinformation spreads online. So he recognized the struggle of fighting falsehoods in an era of rapid digital communication. And really, misinformation is kind of the hydra of the internet, like cut off one head and two more grow in its place. So I think in AI world now that we're with generated content that we're going into, like I think this is going to go into overdrive, and I'm not really sure what we do about that. But next up is Goodhart's law. And this is when a measure becomes a target, it fails. And Charles Goodhart was a British economist. He worked with the Bank of England. He observed that when people manipulate metrics to meet goals, the metric itself starts to lose meaning. So like when numbers become
inflation.
Yeah, exactly. Dot plots, whatever. At one point, in India, there was a policy aimed to reduce the cobra population during the British rule, and they paid people for each dead snake. Well, it backfired when people began breeding the cobras to collect this bounty, and then ultimately it led to an increase in the cobra population once the program was discontinued and everyone just released all the cobras that they'd farmed. So, oh man, basically that's government intervention in a nutshell. All right, next up, Sturgeon's law, which states that 90% of everything is crap. Theodore Sturgeon was a science fiction writer who noticed that while most things in any field are mediocre, there's always a few shining examples of something that's excellent. So, most movies, most books, most TV shows, they're pretty mediocre. But 90% of it is kind of crap, but the remaining 10% is pure gold. And so, we want to be selective. Next up is Tesler's law, Tesler. And this is that complexity is conserved. So Larry Tesler was a pioneering computer scientist. He worked at Xerox their Parc, P-A-R-C, and Apple. And he was passionate about making computers more user-friendly, and he even coined the term user interface. So his law states that making things simple for users increases the complexity behind the scenes. So think about your smartphone. Like it's, a toddler can use it and scroll through and do all amazing things. Like it's so intuitive. But behind the scenes of that slick interface is this labyrinth of extreme engineering, hardware, complicated coding. So you can't really hide it. It's sort of I think risk is also, I've heard Corey Hofstein talk about this quite a bit, that risk can't really be destroyed. It can only be transmogrified or moved or converted into some other form. And I think the same thing is true of complexity. And perhaps the funniest one that we're going to wrap up with is Cunningham's law, which is the best way to get the right answer is to post the wrong one on the internet. Ward Cunningham was an American programmer. He created the first wiki, which laid the foundation later for Wikipedia. And he noticed that people correct misinformation more eagerly than they provide correct information when they're unprompted. So if you post that Toronto is the capital of Canada online, within seconds people will rush to correct you that that's not correct. So weird but very effective way to get information. So in conclusion, these philosophical razors are tools to help you sharpen your thinking, avoid logical traps, and perhaps clear up some confusion. And use these principles to stay clear-headed when possible, and handle misinformation, extraordinary claims, complex decisions, and in a world that's increasingly full of bullshit.
Good one, JT. How did you find that list of razors?
I asked the ChatGPT gods to help me fill out. I knew several of them, but they help for mapping out the space quite well.
Let's use Cunningham's law to see if we can figure out what's happening in the market. You guys feel free to just let us know what the true answers are. But how far down is the market now? We down 5%? Down more than that? S&P 500?
Off of the all-time highs?
That was directed to the hive mind. But if you've got an answer there,
I mean, I think 9% ish looks like. That's an eyeballed
correction at 10%.
Yeah, NASDAQ at 12 or 13 or something.
Gets us down to about 37 on the Shiller PE.
Takes you all the way back to
September last year.
3 weeks ago. No.
What do you think? Do you have any views on? There's an argument that Shiller PE is less useful as a metric for determining the level of the market because the Magnificent Seven over-earn, and they're not oil and gas companies, which previously was the heaviest in them, and obviously much more cyclical. Mm-hmm. So Shiller PE no longer a useful metric, and part of the proof of that is that since it was published in 1996, it's traded the entire time above that. How do you feel?
Yeah, I mean, there's some good arguments. I mean, I think one needs to look at margins to perhaps make some adjustments to, when you went from 6% margins to now we're like at 11.5 or so. Like corporate America is just earning a lot these days, and they've taken a bigger chunk of the total GDP pie for itself. Now, that describes what's happened. The and then what part, a little bit harder to say. Perhaps
so when I say to you that the Shiller PE, I said that the Shiller PE is wrong. You say yes, it's overstating. It's actually more expensive than it looks because margins are are much wider than that. And you prefer Hussman's approach where he says, if you adjust, it looks like it's as expensive as it's ever been.
I tend to want to lean on reversion to the mean at an unhealthy clip. And so if you do that and kind of visualize the world going back to normal things like normal valuations, normal interest rates, normal tax rates, normal interest expense paid, normal profit margins, normal share of labor per capita, in GDP terms, all those things are kind of all push you back in the other direction. And, I think you just have to be kind of a little bit careful anytime you're pretty far out against it's not a market call. I mean, there's absolutely nothing written in stone that we can't go to, Japan type of euphoria.
Japan got to 100 times. China
Yeah,
got to 100 times.
we're way below that. So,
The US is the highest the US ever got is 44 times in 2000, April 2000.
yeah. So
We're
that's
37 now.
still north of here as well. And that there's not one thing I have been thinking about that is kind of, I don't know what to make of it, but I find like when I'm out on my walks, this is what comes into my head. But I think about like the investment game as kind of being sometimes like a game of chicken, and especially the professional version. Like, so who has more courage in their conviction? Like the investment manager and their backing LP base, their customer base, who hold on to something like Costco, let's say at 60 times earnings, and they have to worry about that going to 20 times earnings while they're earning the underlying ROE of Costco. Okay. Or is it the more value conscious manager and their LP base who have to wait around forever for Costco to eventually come back to that maybe more reasonable price of 20 times earnings? And they stay long enough, patient long enough for that to happen? So like, if you kind of like try to boil that down into something a little more pithy, it's like either you're brave enough to hold your nose on valuation or patient enough to hold your breath on the timing. And sometimes it's like this kind of tug of war of like who has more conviction in their beliefs, which I don't know. I'm not sure what to make of that, but that's what I think about while I'm out walking around.
I like that frame. Yeah, so it's courage on both sides.
Takes courage
Bravery.
on both sides. Both will be right over, I think, various time periods, but like who capitulates first? The guy who's worried about it going and he punches out, or is it the guy that had to wait around and all the LPs left because you weren't doing anything and it's swing you bum?
What do you think about the divergence between there's clearly Magnificent Seven and a handful of other stocks have vastly outperformed, and if you back them out of the market, then the rest of the market looks like Europe.
You're saying that
Not,
the crashes here is just not evenly distributed yet?
yeah, something like that. I mean, I think it's interesting that small caps um, topped out in April 22, June 22, somewhere around there. Oil and gas topped out around June 22. And so I don't know what that falling prices, maybe it just got ahead of itself there, or maybe it's a indication of underlying weakness in those small and micro. And that certainly looks like it in the earnings of those small and micro.
I don't know. I think it's interesting to imagine, and I don't know how you measure this, but how much capital is sort of on a hair trigger that is wants to rotate out of what's been working and then has now recently not been working and into something that might be working more. So for instance, like, this year to date, Mag 7, not great so far. But like European stocks have done pretty well in this first, whatever 3 months, 2 months of the year. Uh, how much capital then is sort of like on the edge, the hair trigger of wanting to bail out of what's not working and jump over to what is working, either programmatically because it's a momentum strategy, or just kind of the natural human inclination of like, well, this horse has gotten tired. I'm going to jump off of it and get onto the next horse that's getting ready to go. I think it's like a pretty big chunk of capital that might be that. So all of which is to say that the rotations might actually be quite dramatic as well if you have a lot of capital that's all trying to chase into whatever's been working recently.
It's hard to know to what extent the noise traders make much difference one way or the other, but I feel like up to a large extent the noise traders, there's a lot you can noise trade in crypto, in all the meme coins, all the shit coins,
Sure.
and does that really impact anything anywhere else if that little corner of the market is sort of feeding on itself?
Yeah, I mean it's interesting. I don't know because so you have in any of those things, like at the end of the day, whatever asset it is, the full lifetime cash produced by it and returned to shareholders is what it's actually worth. And like that's where the real value is created. Now, people can get over on each other based on clever buying and selling along that path of eventual distributions of cash. So, something like the crypto complex, my understanding is that it's mostly you just have to get over on the clever buying and selling. There's not really some distribution that's going to, if you just bought and held it forever, that you would earn like an apartment complex that is going to, give you some return on your capital over time as people are paying for a roof over their heads. Well, all right. Now, when people get excited and put a lot of money in there, that allows others to perhaps take money out and then go put that somewhere else. So the way that the money fungibly moves around all over the place, I think it gets quite difficult to wrap your mind around like what are the like second and third order effects of bubbles forming and popping and capital moving around and being destroyed, created on margin. Created in people thinking that they're more rich than they actually are based on mark to market things. And then they, maybe their consumption patterns go up and that gooses the economy. I mean, it's like, it's all just one damn thing after another in economics. You can't take like one piece of the spider web out and analyze it very well because it's so interconnected.
Bitcoin's a funny one. All of the cryptos is funny to me because the argument is it's cash, it's digital cash, in which case, if you listen to a traditional financial planner, they would say you don't want to hold too much cash because over time you can look at the long-term returns to cash. They're negative
It's
to
not
flat.
great, Bob.
Not great, Bob. So if we say, okay, well, it's cash, maybe it's a better form of cash because maybe it
Goes up into the right.
well, it seems to the price has so far, but the part of that is speculation. But there's also an argument that it's you can't inflate it the way most currencies are inflated. So there's a limit on whatever it is, 21 million Bitcoin,
Mm-hmm.
and so
And it's a
you
cool
short the
idea
dollar.
that you could cross a border with $1 billion in your head. That's interesting.
Yeah,
Whereas $1 billion worth of gold in your prison
harder to
wallet
move.
it's probably going to be a little harder to walk across the border.
There are Spanish galleons out there
Uh,
where we tried it in the past. It was hard.
yeah, yeah, that is hard.
I don't know if you can fly it or not. Probably expensive.
Hmm.
I just it doesn't make me want to hold it necessarily. Like if I accept the argument that it's cash, then okay, that's fine. Then I want a small allocation to it. If you guys feel free to jump in and tell us where we're wrong. I don't know what happened to the guy who was very bullish MicroStrategy's gone the other way since then. Yeah, digital scarcity. That's the argument for it.
Yeah, but aren't they like making 1 million of them every day? Like you read these stories of some
Yeah, that's the meme coins.
14-year-old kid that like puts out his own little, poop coin or whatever and talks it up in a Discord, and everyone jumps in when the price goes up. He takes 20 grand out of it, and the whole thing collapses. And like, what did we accomplish as a species here? It's,
I mean, the argument was that I like this one. It's good framing for crypto and Bitcoin is it's a global gambling game with a 100% payout ratio.
hmm,
Yeah.
sure, but then that assumes that again, like this is a zero-sum game. You have to win. You have to get over on people. You have to be clever in your buying and your selling. And I'm not attracted to games like that, to be honest. Like I want to be part of win-win, like long-term productive capacity for humanity type of situations and not can I like get over on the next guy?
It seems like there's a lot of gamble to me in this market. There's gambling apps everywhere. Everybody gambles on everything. I was at Vegas last week at an
I bet
Australian.
I can get you to gamble before the end of the show.
Oh yeah.
Yeah,
All right.
I'll take that. 10 to 1 odds. Sorry.
And I was talking to I was talking to a younger guy, and I said, like, do you, do you gamble? And he said, oh, not much. And he showed me his app, and he's like, and he had like 3 bets on for that game, and it was like, the who
Yeah,
scores
over
first,
under
who
and
wins. Yeah, yeah, yeah.
all prop bet stuff.
And I was like, that's funny that in his framing, that's not much. I mean, maybe it wasn't
It's
much money.
And what does that do for the your dopamine part of your brain when you are just like a constant bet on at all times? That can't be good for the human animal.
Well, they know that people log into their accounts at 3 or 4 a.m. and they've set up to give you a little reward if you do that,
Oh my
little
God.
dopamine hit if you do that. Speaking of which, there's a possibility that the Nasdaq introduces 24-hour trading.
That is a horrible, horrible idea.
Is it?
For what purpose?
But why not? I have to buy, I have to buy some shit. I have to buy some shit at 3 a.m. in the morning. What am I going
Oh,
to do?
that's usually when the best decision making's happening, right? For
I mean, that's why all of that long form marketing, long form
yeah.
advertising on television. That's why that made so much money because people were prepared to sit there and let you advertise to them for an hour at a stretch.
Hmm. I prefer I think it folded up now, but there was a market that was intended to be long term oriented. Like it got rid of all the high frequency trading. It had
Yeah, what
like
happened to that?
I think it folded
Long-term
up.
stock market.
Yeah, something like that. I think it might have folded up, but that's a shame because that was a credit to our species, and I don't think 24-hour trading is a credit.
But then there are other markets in the world. There are other time zones in the world they can trade on Nasdaq during their business hours.
Sure, fair enough.
We got someone in from Cronulla. I'll give them a shout out because they wanted a shout out. I watched the Sharks in Vegas. Um, let's talk value for a little bit. How do you feel? Tell me, give me some good feelings about value.
Yeah, you want some confirmation bias?
Give me some confirmation bias.
Um,
From what you're seeing, do you think that give me the temperature, the sentiment of value guys who you talk to?
hmm. Um, have you seen any Vietnam vet? Have you seen Jacob's Ladder? Oh no.
Optimistic about the portfolios. I mean, I feel pretty good about the portfolios. I can see the rebalance coming up, and I feel like I felt like late 2020 when everything had ripped and value hadn't really moved, and I could see that nothing really had to happen.
Yeah,
You didn't need the multiple expansion for the returns to be quite good. I thought the embedded sort of growth
yeah.
and
I'll
flows
make
were good.
one observation is that for a lot of the international value guys, the underlying businesses have done reasonably well, and that like where you can say like yeah that was like that was a decent business to be a part of over this time period that you've held it. The multiples have gone the other direction in such a way that it occludes
Yeah.
the results of the manager and makes them look like they don't know what they're doing. I think that this too shall pass when it comes to those type of contractions and multiples, and eventually the business results at the very end of the day will outweigh it, but you just have to be patient and keep doing what you're doing. So I think in general, like there's a little bit more pounding of the table, I think, right now for like, hey, our business results have been pretty good. Like I know it doesn't look like it in our NAVs that we're reporting, but that's probably not the worst setup that you can imagine for a value guy.
Yeah. Yeah, I tend to agree. Well, folks, I think we've come to the end of the show. JT, good effort as always. You want to plug Journalytic? I'll plug it for you. Journalytic.com. I use it. It's great.
Yeah, thank you. Yeah, yeah. I don't want to get too far ahead of, but there's some really cool stuff in the works right now behind the scenes for more there, and it's gonna be. I think it's gonna be pretty special. I've been using an early beta version of it. It's more team oriented and less of a solo player version, and yeah, it's gonna the a lot of the AI stuff I've been working on to bring that to the table is like I think it's going to be pretty kick-ass. So I'm excited about that. But I don't want to let the cat out of the bag too early here. But stay tuned.
I always get asked what young investors should do to learn to be better investors. And I always say write down what you're doing so that when you
Oh, so
revisit it three
huge.
to 5 years hence, you have an idea why you were doing something. And Journalytic is very good for that. And that's I still use it that way. I put down my positions, guess which ones are going to outperform and which ones weren't, which ones
Yeah.
won't, and find out after the fact that I still don't know which ones are going to do which. And so I should stick to doing it the way I'm doing it, which is quantitatively.
The feedback loops are so fiendishly long that the human brain is not good at tying together cause and effect on that long of an interval. Like it's not the environment that we evolved in. Like we're much more like, oh, you hit your head on that branch, it hurts right now, you know. So it's you have to like you want to have a tool like a technology that helps you to close that feedback loop, and you have to write things down in order to do that. It's so easy to trick yourself into, you know, revisionist history of what you thought at the time. And when you go back and read some of the things that you actually did write down, you're like, is this the same guy? Like, what the hell's going on here? Someone in here tampering with it? There's no way. That guy's an idiot. So, the best I think you always want to look back and feel like you were an idiot because otherwise you're probably not really making progress.
Good stuff. And if there are any independent RIAs out there and you'd like to talk about how value can help your portfolios, then give me a DM or a tweet or a email. I'm available on lots of different services. Just wolf at me and I'm available for a chat.
Hmm,
All
let's
right,
go.
everybody. We'll see you
Next
next
week.
week. Same bat time, same bat channel, not bad time, bad